All right, let's talk Axcelis Technologies. They just dropped their second quarter numbers, and wow, the market went nuts for it, sending the stock soaring. Now, on the surface, it was a fantastic quarter. But, as we're about to see, there's a pretty big catch that every single investor needs to know about. Okay, let's get into it.
So the headline number that got everyone talking was this, $1.13. That was Axcelis' non-GAAP earnings per share for Q2, a huge number.
And to really put that into perspective, just look at the sheer scale of this beat. Wall Street was expecting something around 72 cents. Axcelis didn't just squeak by, they absolutely blew that number out of the water. And it wasn't just on earnings either. Revenue also came in hot at over $194 million, when the consensus was sitting closer to $185 million. I mean, this was just a massive, massive outperformance.
So the big question is, how did they pull this off? Especially when management themselves are saying the whole semiconductor industry is in a bit of a cyclical digestion period? Well, it really boils down to two key things that went very, very right for them.
First, let's look at this slice of the pie right here. Their CS&I business, that stands for Customer Solutions and Innovations, made up about 30% of their sales in the first half. Think of this as the stable, recurring part of their business. It's all the spares, the services, the upgrades for the huge fleet of machines they already have out in the wild. This is their rock-solid money-making engine. And this quote from the CEO, Russell Lowe, really nails why that's so important. He says, the margins on that CS&I business are materially higher than the rest of the company. So that super profitable revenue stream acted like a giant cushion, helping the whole company post a really impressive non-GAAP gross margin of 45.2%. That's strong. Okay, so the second engine firing on all cylinders was the power device market, specifically silicon carbide, or SiC, as you'll hear it called. Demand there is still really strong, and a lot of that is coming from China to support their massive push into electric vehicles. And on top of that, you have to give management credit. They showed some serious discipline, keeping a tight lid on costs to deliver a solid 20% adjusted EBITDA margin. So you've got great top-line drivers and tight cost controls. Yeah, that's a winning formula. But great headline numbers don't always tell the whole story, do they? The market cheered the results, for sure, but when you pop the hood and look a little closer, you start to see some potential cracks forming in the foundation. And this brings us to what I think is the most important question for the entire quarter. With all this fantastic revenue from shipping products out the door, is the company actually bringing in enough new orders to replace that business? To answer that, we have to talk about a really critical metric in this industry, the book-to-bill ratio. It's actually pretty simple. It just compares the new orders they booked to the products they billed for or shipped. If that number is below 1, it's a warning sign. It means you're shipping out more than you're selling.
And Axcelis' book-to-bill ratio for Q2 was 0.8. And there it is, that's the catch. For every dollar of equipment they shipped, they only brought in about 80 cents in new orders. And the result? Well, their system backlog, which is basically their pipeline of future revenue, it actually shrank down to $582 million. So you really have this split personality in the quarter. It's a tale of two tapes. In the green corner, you've got all the good stuff. Fantastic execution, that huge earnings beat, awesome margins, and strong demand where it counts. But then, in the red corner, you've got these weaker forward-looking signs, that book-to-bill under 1, a shrinking backlog, and the fact that the memory market is still pretty soft.
So, with this mixed bag of looking back strength and looking forward caution, what's the game plan? What is management actually doing to navigate through this part of the cycle?
Well, their strategy is pretty clear, and it has three main parts. First, they're protecting the house. They have a fortress of a balance sheet, ending the quarter with over $580 million in cash. Second, they're using that cash for shareholders, buying back a hefty $45 million worth of stock in Q2 alone. And third, they're not taking their foot off the gas when it comes to innovation. They're still pouring money into R&D for their key technology, that high-energy stuff for the all-important silicon carbide market.
All right, let's bring it all home. We've seen the strong results, we get the caution hiding underneath, and we've looked at management's playbook. So now it's time for our take on what happens next. We call this the next call. Okay, so looking ahead to the third quarter, management is guiding for revenue right around $200 million and EPS of about $1. Honestly, we think they'll hit those numbers. Their execution is just too good right now. The real question is what the stock does. And with these conflicting signals from the book-to-bill, our prediction is that the stock is probably going to be stuck in a range in the short term, at least until investors see some hard proof that new orders are starting to pick up again.
So putting it all together, we're initiating our coverage with a market perform rating. Look, the company is executing flawlessly, and they're hitting the sweet spot in the SiC market. But you just can't ignore the warning signs from a declining backlog and a book-to-bill under 1. So that justifies a neutral stance for right now. We really need to see those orders turn the corner before we can get more positive.
The number one thing for investors to watch on the next earnings call is going to be that book-to-bill ratio. Can it climb back above 1? Because that will be the real signal that a recovery is starting to take hold. And of course, please remember this is not financial advice.